Hello everyone, my name is Adriana Calderon. I'm the lead partner of Transfer Pricing Solutions Asia based in Singapore, and today I will be speaking about managing the impact of COVID-19 on transfer pricing, specifically on distribution, sales, transaction, and business models. So before I enter into the topic of today, let me just give a brief overview about our firm. We are a specialist firm that provides practical, proactive, and cost-effective transfer pricing advisory to multinational companies. We are ex-Big Four advisors based in Malaysia, Singapore, and Australia. I have more than 15 years of experience advising multinational companies in how to manage their transfer pricing risk across a broad range of industries, business models, and transactions. So as I was saying earlier, we will be talking about the impact of COVID-19 in distribution transactions. So I want to open this webinar with a small image that is funny but true, whereby basically we used to test distribution entities on EBIT or EBITDA, and now what we have to understand is basically EBITDA and COVID, meaning earnings before interest, taxes, depreciation, amortization, and coronavirus. And that's the goal. The goal is basically to understand whether COVID-19 has impacted my bottom line profitability and whether that taxpayer needs to do adjustments to that EBIT due to COVID-19. So what is the impact of COVID-19 in transfer pricing in general? It could impact in different ways, such as need to modify the price of a transaction, need to modify a contract, the need to modify a supply chain, the need to perform end-of-year adjustments, the need to adjust transfer pricing documentation, and the need to adjust benchmarking. So before I go through a brief case study scenario, let me just give you an overview on IRA's position on the effect of COVID-19. So IRAS released a transfer pricing guidance to address the effect of COVID-19 in September 2020 after conducting a survey of transfer pricing practitioners in Singapore, including our firm. So some of the measures are actually very welcome that IRAS has stepped in and issue a very early guidance so taxpayers could have some level of certainty on how to address year-end planning and how to take action at year end before the closing of the books. What are the main key changes released by IRS in the transfer pricing guidance? There are 4 key aspects that IRS have provided some guidance on. Point number 1 is on the industry analysis, whereby it is key for taxpayers that are impacted by COVID-19 to have evidence of the impact on the industry and evidence with very reliable and substantial numbers that are sourced from reputable research to ensure that they can show how the industry has been impacted. The second point that is addressed by IRAS is the functional analysis and the need to do a before and after COVID-19 functional analysis to support any recharacterization of entities and to support which entities in the group make decisions related to the management of risk relating to COVID to understand who should bear any excessive cost associated with COVID-19. So point number 3 is the importance of keeping evidence on the 2 points above. And one last but not least change is the welcome measure to allow multi-year analysis, which is basically doing a comparison of 3 years average versus the benchmarking result and making a decision whether there is a need to do TP adjustments. So let's talk about with a clear example of what are the different or the application of IRAS TP guidance on distribution and sales structures. So the typical sales structure encompasses something along the lines of having a manufacturer in Singapore, mainly outside of Singapore, that provides products to a distributor located in Singapore. And there are 3 key issues that could arise from this business structure. First is how is the price being set up and tested. 2, what is the profile of the entities? And 3, can the entity, meaning the distributor, absorb losses? So what we have seen in the market is 3 different scenarios, which I will go through in the following slides. Scenario number 1 is a distributor of electronics located in Singapore that is basically having healthy profits in 18 and 19, and 20, it has an abnormal loss. And basically that abnormal loss can be evidence, or there is enough evidence to show that this abnormal loss is related to COVID-19. In this scenario, then what IRS is allowing the taxpayer to do is to do a 3-year weighted average analysis and compare the 3-year weighted average analysis, meaning 18, 19, and 20, versus the arm's length result that is in the benchmarking study. So as we can see here in this scenario number 1, the weighted average 3.56% falls within the range on both 19 arm's length range and the average arm's length range. So in scenario number 1 is the best case scenario where the taxpayer wouldn't have to do any transfer pricing adjustment. Then we have scenario number 2, where we have a similar situation of healthy profits in 18, 19, and then a significant drop in 20, but that drop in 20 is a lot deeper than in scenario number 1, giving as a result a 3-year weighted average operating margin of 2.54%, which is below the arm's length range, meaning it doesn't even fall within the lower and upper quartile, not for 19, not for the average. So this scenario is actually included in Singapore TP guidance, and it's very clear that in this particular case, the taxpayer may need to adjust the 3-year weighted average operating margin to the range, meaning 3.2%, and make sure that that adjustment is done before the closing of the books in 31st December 2020, and that will be sufficient to comply with the arm's length principle. And we can have a third scenario, which is basically where the distributor also has healthy profits in 18, healthy profits in 19, but a much, much, much deeper loss in 2020 that gives as a result a complete loss position on a 3-year weighted average. So in this case, the taxpayer will also have to make the decision on whether it has to adjust this 3-year weighted average to make sure that it's within the arm's length range. And some of the key tips that we have been doing or have been giving our clients is to check, first of all, the characterization of the distributor, because in a scenario 3, for example, whether that distributor can bear these losses will depend upon the characterization of the distributor. So if the distributor is a full risk distributor, maybe there is some basis to not do any adjustments. But if the distributor is actually a limited risk distributor, you will have a lot more difficulty to say why is that distributor bearing the loss, and maybe an adjustment is required. Also, check if the contracts are available and check any avenues to modify the terms or the price that is being agreed in the contract, but keeping in mind that doing retroactive changes to the contract might not be acceptable by tax authorities. I also suggest that all distributors monitor the end of year results to make a decision whether an adjustment is required or not based on the benchmarking and the characterization. And my last but not least is check the results against the benchmarking early, so if any adjustments are required can be done before the closing of the books and not later in the year where the audit is completed and adjustments will be rather impossible to do. So if you have any questions or you want any assistance, you can reach us on this email, on these phone numbers, and feel free to follow us on our social media networks such as YouTube, Twitter, Facebook, LinkedIn, because we publish it frequently, webinars, blogs, and interesting, valuable information that can help you to manage your transfer pricing risk. Thank you.